Hi, this is Randy Finney with Right Side of the Chart, and today is Sunday, May 1st, 2016. In this video, we'll take a look at the U.S. equity markets. I've made the case last week. I believe we're most likely looking at a broad-based sell-off in the equity markets. By broad-based, I'm referring to the fact that most everything, the majority of sectors that I'm looking at, anything equity related is likely to go down with it. That's in contrast to what we've seen most of this year, although we did have pretty much a broad-based sell-off that kicked off with that New Year's gap, I call it, on January 4th when the markets gapped down. We had the impulsive selling down into the January and February lows, and since then it's been a lot of sector rotation. The market's gone up. However, there's been money to be made, and great money on both the long and short side. Pretty much in 2016, we've seen sectors like energy really rebound off the lows after getting hammered. Gold stocks, certain commodities, oil. So there's, like I said, been a lot of sector rotation. And if my read on the charts is correct, this time around, there's not going to be many places to hide. You can always stick money in treasury bills, things like that go up when stocks fall. But I think for the most part, we'll see a lot of ships go down with the falling tide here, if I'm correct. This is a 20-year chart on the SPY, the S&P 500 tracking ETF. And what you can see here is this is really the secular bull market in equities that we've had, and these white trend lines here show you the cyclical bull market. So we had a cyclical bull market, a breakdown, then a cyclical bear market, bull market, cyclical bear market, cyclical bull market, and I've made the case that I believe that we're most likely in the early stages of a new cyclical bear market. Interesting to note, if you look at this long-term trend line going all the way back to the mid-80s, this blue up trend line, we had a breakdown here. It was a well-defined trend line, breakdown, further validated by that impulsive price action. When you have a breakdown of support and you see the impulsive selling come in afterwards, that only helps to validate that is a key level. And as you can see, after the 2007 to 2009 bear market, which ended March of 09 right here, we had the bull market that we've been in since then. And that came to just backtest and roll over right off that trend line. So interesting to note, how well, even going back to a chart that spans decades using monthly candlesticks, technical analysis works just as well on that time frame as it does 15-minute, 30, 60-minute charts, daily charts. So that's that. A lot of things, I won't go over my trend indicators now because I've done that recently. A lot of nearly all of my long-term trend indicators remain bearish right now for the equity markets. I'm talking the various different U.S. stock indices, small, mid caps, large caps, Wilshire 5000, S&P 500, you name it. So that confirms this ROC 13 is just one trend indicator, and that confirms that we're in a bear market as well. You can see down here that's red. That shows you the bear markets in the past. Does a very good job, and I also, as I mentioned on my longer term trend indicators, use it with other various other metrics. So that's that. So basically there it is. You can see the most recent cyclical bull market uptrend line breakdown, and as I've maintained for a while now and continue to believe, this is nothing but a bear market rally. Here's a weekly chart now on the SPY, so we're cutting down to a 10-year time frame. Here's some other trend indicators. The PPO, I like to use the 9 EMA, which is a signal line on a weekly chart, a PPO, which is a cousin to the MACD. It works similar. And you can see how well it does. I've talked on this one a lot. Does a great job of defining bull and bear trends when that white line is below the dotted line, which is the zero line. The primary trend is bearish, and when it's above, the primary trend is bullish. So you can see that it would have, got you short most of the bull market from 07 to 09, had you long throughout nearly the entire duration of the bull market that ended so far in 2015, and still that white line is still below. You can see there it's just now actually back testing, as I mentioned, and usually tests from above or below tend to act as support or resistance. So in other words, the white line is now resistance. We had that one test here, rolled over. We're testing again, and again, based on not just this chart, more so what I'm seeing on the shorter term charts, expecting a pullback, the case can be made there. If that proves to be the case, then you're going to see this white line, the 9 EMA, roll that back over and keep us in confirmed downtrend or primary downtrend. So there it is. There's your uptrend line breakdown. We're at resistance right now. You can see this downtrend line here captures, comes off the highs in 2015, has several reactions, and the market's tried to, I can even tighten this up a little. It's not right on there. Lift that up to capture these two candlesticks right here and here. That's a better draw. So we pierced through their intra-week but failed to close on a weekly chart. All that matters are the weekly closing candlesticks, and so far we've rolled back down. So yes, the near-term trend is still up until proven otherwise, but right now the market's pretty much stopped where they should have, and we'll zoom down now to a daily chart. This chart looks busy, given a lot of lines on here, a lot of past things I posted in past. One thing I'll point out here, and I hadn't before, I've showed this chart many times. These are divergent highs, divergent high, each divergent high, divergent high. By that, I'm talking prices making a higher high, as they were, against the MACD, which is down below, and the RSI up here, making a lower high. So you can see the divergences drawn out, and at each of those points, as I pointed out, divergent high, correction, divergent high, correction, divergent high, correction, divergent high, correct. Well, the last time I updated this, we were right up here, and I was anticipating the correction, hence the question mark. So we got it, and then some. And here we are. We've come full circle. This is the first divergent high, and again, I'm not on a daily time frame. I get divergent highs on 15-minute charts, 5-minute charts. If the primary trend is up, the near-term trend, I might ignore those because they tend to, in an uptrend, negative divergences will often be burned through or not play out for very much. However, when I see divergences on the 60-minute, especially out on the daily time frames, and keep in mind this follows up with the longer-term, bigger picture. Those are about as good as you get for an indication of an impending trend reversal. That's all divergences are. You look at, these are momentum oscillators here. The MACD is a momentum oscillator, indicator, I should say, and here's the price oscillator. So when you see these divergences, prices making higher highs, such as on this line drawn here, versus the MACD making a lower high, the RSI making a lower equal high, in this case slightly lower, that is a divergent high. And again, nothing is 100% in trading, but this is what I put a lot of stock into my own trading, and I can tell you that 9 times out of 10, if not more, these play out. Well, in fact, it's already played out for a correction. There was the divergent high right there. So call it what you want. We've already dropped from that point to the lows about nearly 3%. However, I'm looking for more than that in this one. And here's some targets for those of you trading the SPY. These aren't hard targets or anything official. I don't have the SPY as an official trade. I should have a line right here as well because I definitely see a support level there. That's 203.54 roughly. So there's your targets. Then you have support here. There's a nice gap. There's the New Year's gap right there. The Qs never took it out. The SPY did. SPY had a lot of energy, commodities, all things that I was bullish on and long recently. So it doesn't surprise me one bit that the SPY took that out. However, look how perfect. I mean, here you are on the daily time frame. 1, 2, 3, 4, 5 reactions off that downtrend line, off the highs, and failure. So far, price is starting to roll over pretty impulsively. And again, confirmed with the divergence, it just doesn't get any better than this in my book, folks. So that's what I see. And we'll look at a couple others and wrap this up. So I don't want to beat a dead horse here, but I do see similar things here. Here's the Qs, Nasdaq 100 tracking ETF. Here's their highs back, and they were the holdout index, and they're still on my long-term trend indicators, the only one holding out. But that doesn't matter because the Qs, the Nasdaq 100 is not a very diversified index. It's only 100 stocks, and of that, the top 10 make up well over half the entire Nasdaq 100. So it's a tech-heavy, top-weighted, but with the top components, and it doesn't have every sector out there. It's missing things like financials and stuff. So the Nasdaq Composite has rolled over even on my longest term indicators, and has confirmed a bear market. So this is, again, bear market rally. This is the last holdout. Probably a lot more downside in the coming months. And as I mentioned recently, I did a video a week or two ago showing that the leaders, making a bearish case for the leaders, the top components in the Nasdaq 100, and they are definitely breaking One by one, they're starting to go. And you can see here from the highs that we had back in November, there was a downtrend line, and we had a breakout, and that breakout failed. And as I often state, fewer things in trading are more bearish than a failed breakout. So, bulls see what they want to see, bears see what they want to see. I try to take, everything into, the big picture. I can recognize a breakout for what it is, but I also think I do a pretty good job of recognizing which breakouts are likely to succeed and build on, and which ones are likely to fail. So this one failed. We had everything just so the charts have been just perfect lately for this setup for the reversal in the markets. We had this bearish rising wedge. Now keep in mind we had a rising wedge on the 60-minute charts for a long time that broke down and didn't play out. Markets went sideways. So it was quite frustrating. I'll tell you, I expected us to reverse back here. Anywhere, especially at the bottom of that gap, there's the New Year's gap circled, and we punched up, but we backfilled almost the entire thing, but not all the way to the top. And remember, that was my line in the sand, really, the top of that gap. If we got above there, I would start quickly, getting out of what shorts I had and really change my tune on where if the market's going to new highs or not. So far we failed, came down. The Qs have rolled down impulsively. We had the rising wedge. See the bearish rising wedge pattern here with these two lines. Breakdown, back test, prices roll over. We also failed for those that were watching this downtrend line, failed breakout of that downtrend line. And we're at support, or at least on Friday. I'm doing this video Sunday. We hammered or closed right pretty much on that support line. I've had this support line here for a while, I believe. That says, created on August 12th, 2015. And haven't updated that since March 13th. So that trend, that support level's been there. You can see it's pretty well defined right here. All these reactions, and that's a key level. So let's again, next week will be very telling. Maybe the divergences played out for all they needed to. Certainly by the scope of that wedge, if you want to take the bullish side of this, you measure the widest point of the wedge, which would actually be right there, and you add it to where prices broke down right there. Now we back tested higher. You can add it right there and say, okay, well, there's a projected measurement if you want to do it that way. There's a lot of different ways to measure these wedges. Some people add it to the top of the wedge, the highest point, in which case it gives you the projection. So maybe the correction's over, maybe not. I don't think so. But we do need to take out last week's lows, Friday's lows. You can also see in the Fibonacci, see the dotted line there, that's the 78.6 fib. That's another level we stopped at, a key Fibonacci retracement. And again, just like on the SPY, I pointed out these divergent highs on the Qs. And this is the first daily divergence, negative divergence that we've had since right before the big meltdown, the big correction in early January when we broke down from this trading range. Now you might say, well, Randy, that's a very small area of divergence. Look at the scope of these prior divergences. Yes, however, this is a very steep rising wedge. When you have a steep rising wedge, you're going to see much smaller divergence at the high. If this was a long, drawn-out move, let me try to visualize what's in my mind's eye here. Let's say the market from that point went up as much as it did, but took this long to get there and then started to reverse. Sure, at that point you would have a longer divergence on there on the MACD and the RSI. So I'm very comfortable with the fact that we had this divergence. And again, if my bigger picture read is correct, which we'll see, we're not too far from the highs. Maybe it'll prove to be wrong. But if so, and this is a bear market rally, that's why I'm expecting a lot more than just this move down. Possibly kick off a leg. Maybe the next leg down, or quite possibly the next leg down in the new bear market. But we'll see. As I often say, trading, when you're trying to use the charts to forecast price action, it's a lot like meteorology. Forecasting the weather. The weatherman can tell you with a pretty good degree of accuracy whether it's going to rain in the next hour, next couple of days, tomorrow, the next day, maybe even a few days out what the weather will be like. But when you start going out a few weeks, even a few months, that forecast, the cone of accuracy just broadens from there. And so right now, all I'm focused on, whatever my longer term views are, that doesn't really affect my positioning. It does affect how I'm interpreting these charts. In other words, I'm not going to position something. I'm not going to hold on to a short trade if we get above these, all my shorts if we get above these recent highs, or especially if we backfill that gap there. I mean, take out the top of that gap. But I haven't listed targets here on the Qs on this chart. I probably should have done that before this video. I gave you a few on the SPY a minute ago. But let's just say right now, eyeballing this chart, I'd expect to move back down to this S1 zone. These were zones that I had way back here, expecting from this move down, which we got in this one here, and that's where I covered a lot of longs. This is where I was bullish recently, and then started peeling. Well, I did trade a lot of individual stocks at that point, and even up until recently. But this is where I started looking for a reversal for this rally, and we've pushed up a little more. But again, we never exceeded my uppermost threshold. So far, so good on this longer-term bearish case. Look for that to be a very critical support level if and when we get there, and that's around 95, 96 on the Q. Let's say the bottom of that level. So a little bit below 95, 94.50. The reaction lows from back in February, where trading normalized. There was a mini crash in a lot of the Qs and some of those individual stocks. But this is where trading really normalized that day. I mentioned that before, and we had a big gap back here. So very important support level if and when we get there. And there's a ways to go until we drop there. That's another almost 10% drop from current levels. So we'll see. We'll just take it from there. And let's see what else I wanted to cover for you real quick. IWM, we might as well look. Small caps, a couple people asked when I put up some of my favorite sectors for the short side on the site recently. Quite a few people asked, well, what about the IWM? And yes, I actually, personally, I'm short that via TNA, shorted the 3-time long ETF. Yeah, I think a lot of meat is on the bone for an IWM short. There's the downtrend line off the highs, similar to the Qs. Breakout. Can't call it a failure yet because we just managed a little. See that stick save? You see the candlestick from Friday, how we have the shadow right there, that wick or tail. But then the body closed right back up on the downtrend line. So again, next week will be pretty telling. Any more downside in the Qs and IWM, I should say, or in IWM, will help strengthen the bearish case, because then we will have a failed breakout above this downtrend line and more follow through on the breakdown from the rising wedge. You can see here's a rising wedge pattern off the lows. I could draw an alternative. I could probably draw it like that. I think that's a little more true. Have that just be a false breakdown. There's more touches there. So we've definitely broken below that rising wedge pattern, which is a bearish pattern. Negative divergence confirming, and some pretty healthy divergence too on the IWM if you look at that going all the way back to early March. So again, it doesn't get much better. And talk about meat on the bone, this one just broke down and we're still not far off the highs. The Qs have already rolled over. And again, the Qs were the leading index. That's why I was putting a lot of stock in that, following the Qs, watching those, and the leader is now dead. So there you'll see this is a risk-on, risk-off index like the Qs. And so if there's more downside and the Qs continue to move lower, I can all but guarantee you IWM will play a game of catch-up, because it's a risk-on trade. It's been risk-on since the February lows. And if it's all of a sudden a risk-off trade out there in the market, they will sell the small caps. And the IWM, I mean, at least I could see this one coming down to at least this line here. I should say, let me put a target right here for you. Near-term target, 108.50. And I really wouldn't be surprised to see us get down here to these reaction lows around 105.66 area. And again, we'll take it as it comes, but that would be, I would say, my preferred target right now. Call it 105.70 on IWM. And if you trade the 3-time leveraged ETFs, you have 3 times the returns, but you also have 3 times the exposure. So just make sure to adjust your position size accordingly for the extra leverage. There's one of my weekly charts. I have a lot of different weekly boards on IWM. But this one looks like this broadening wedge pattern here, descending broadening wedge pattern. These are the Fibonacci lines that I've mentioned, Fibonacci fan lines. We've broken below, and that really, the IWM has already been in a confirmed bear market. There's no arguing that. We've already dropped more than 20%, I believe, in that one. Mid caps. It's a messy board. Let's see what I have on the daily. Haven't really marked this one up, but mid caps look pretty healthy here. You know, taking out the that downtrend line and still well above it. However, you can see the divergence. Forget about everything. Let's just go to a clean board for a second. Let's just look at the recent move. Two ways to do this. We can draw an uptrend line like this. Note the divergence here. That gives you this rising wedge pattern. Negative divergence on the RSI right there. Negative divergence on the MACD, which indicates a likely trend change, and so far a breakdown. And for those of you that want to be safe, you could put an alternative trend line here. I could probably make one right about there. Actually put it up in this ascending channel. So these two trend lines have this steep ascending price channel. Other words, the net effect is the same. What I'm looking at, if we break much below Friday's lows, there's a little support right there at 262.44 on MDY, and again, that's the mid-cap ETF. But much below Friday's lows will be a, I don't want to call it a nail in the coffin, but will certainly help increase the near to intermediate term bearish case. All right, I think I'll wrap it up here. I've already put together a video on the global markets. If I have time tonight or tomorrow, I'll put one on gold. I'll do a video on gold, maybe oil, some commodities, and maybe an update on some of the sector ETFs. So remember, folks, that we're still in earnings season, and so it's like a landmine out there. Even though the market's rolling over, at least the Qs have rolled over, there are stocks that are popping. You know, we had some are popping up, some are dropping down. We had Amazon, and that's what I'm on watch for. I actually shorted that the day of earnings, and I'll wait and see what happens with Amazon. Looking at a potential wedge overthrow here. I want to see some follow through. If we gap down tomorrow, I mean, there's a beautiful potential for either an island top or an island cluster top. I think this is a wedge overthrow here, wedge overshoot. But you know, this trading into and around earnings is choppy. Again, I didn't have anything in Amazon until after to the day they announced. I shorted when I mentioned it was right around, was either at the bottom of this gap or no, coming up to the top. That's where it was. That's where I shorted it. I pointed that out in the trading room. The top of this gap would be a significant level. You don't see it on this candlestick because it traded higher in after hours trading. So, you know, I'm already positive on that trade, but you know, not celebrating yet. There's a lot of work to be done. This would be more of a swing trade, and so that's what we're watching for. So maybe a gap down and someday this coming week, possibly tomorrow. Doing this video, the futures haven't started trading yet, so I don't know what's going to happen tomorrow. But that's something I'll be on watch for. And near-term target, I think somebody asked me the other day where my targets were. I can't remember if I listed. No, I didn't, because I'm still looking at this as a potential for some longer-term bearish developments. But that would certainly be a quick pullback target. You can see a reaction high right here, several reactions right there from above, and then the reaction highs right here. And that level was, I just had it highlighted. Call it, yeah, a little 630, 736, give or take. So that would be for a quick pullback target. All right, I'll wrap it up here. This has been Randy Finney with the right side of the chart. Hope you enjoyed it.